So, warm welcome, everybody, and good evening. I hope my voice is loud and clear. If it is loud and clear, please give me the green signal in the chat box. Am I audible, Jamshedji? Okay, great. So thank you, Sandeepji. So friends, uh, I think most of you know me. My name is I am Rupesh Shah, and today I have a golden opportunity to share my understanding about the financial statement and the analysis of the financial statement. The intention today of the session is actually a request came from a lot of members to get basics of the financial statements and also to understand how to analyze these financial statements. So friends, my humble request to all of you to make this session very interactive and ask as much question as possible. Chat is not enabled. So how to enable the chat box? Can anybody help me? Yeah. Can anybody help me how to enable the chat box? Yeah, Sandeep ji, I have given you the rights to speak.
No, I don't have any idea actually how to do it because this is a different mode. I use Zoom in a other.
Okay. So, anybody else having idea how to enable the chat box? Yeah, I know host can enable, but how to enable? Okay, or we can use the Q&A box to to chat. Is it okay? Okay. So let us start with the sharing the the presentation. I hope my presentation is visible on your screen, right? The purpose, as you can see, is to discuss about the basics of the financial statement. Now, the very first question arises, what is financial statement, right? So let us, first see the agenda, what we are going to cover today. The very basic questions we are going to cover, what is financial statement? Then we are going to cover, the components, right? Basically, what is P&L, what is balance sheet, and what is the cash flow. Then we'll see what are the tools available for analysis of the financial statement, mostly the ratio analysis and the cash flow analysis. And then we will talk about the case study, one for a good company and a case study two for an average or a below average company, right? So let us deep dive into this. Now, as you can see in your screen, the financial statement is nothing but, it is a written record of all the transactions, all the business activities, that has been done into a particular business, right? And it basically tells you what is the financial performance of a particular business entity. Here, a fundamental question arises, what is the meaning of business activity? So we have to first understand the business as such. Now, when I say from the context of the investor or from the context of the businessman, we have to understand the business in a slightly different manner to understand this particular statement, right? So let me just write something here that there is some mental model which you can use to understand the business, because people understand business in a different manner. Normally, people say it is a buying and selling activity, manufacturing and selling activity to earn the profit, etc., etc. That is okay. That everybody agrees about this, that there is nothing wrong in that. But from the perspective of the businessman and from the perspective of the investor, how we should look at the business or the business activity. So if you let me just bring one blank slide here, right? So Now, whenever we try to understand the business, we should always use this kind of a mental framework. Now, please pay attention very carefully because this is what I am trying to tell you. You will not get in any books or in any, even in the internet also. But this is very, very useful because I am trying to give you my 25 years of experience. So say in any business, when you say, I want to start my business, the very first thing what I will do, I will put some capital into my business, right? Say I want to start a showroom for ready-made garments. Then very first thing I will look at how much money I require. I will think about that. And for that, I will think about that I have to buy or I have to take on rent a particular shop or a particular showroom. So when I have to discuss, I have to take that decision of purchase of any particular shop or take it in on rent, I am talking about an investments activity. So in business, it's divided in two parts. There are certain activities and there are certain transactions. So business is all about this 3x3 matrix. So when I say that I need a particular shop in a particular place, either on rent or on an outright purchase basis, I am talking about a capex or talking about an investment activity. And I need money for that. So I have to introduce capital into my business. And that is actually a financing activity. That is actually the financing activity. Then question arises, once I have my investment in place, my finance is in place, then I talk about from where to purchase my goods and where to sell my goods, right? So this is called my operating activities, right? So business actually classified into three activities: operating activity, investment activity, and financing activity. Now question arises, what are the various type of transactions into the business? So there are cash transactions, right? And there are credit transactions, which is nothing but the accrual transactions. So let us take an example. When we talk about a cash transaction, say I want to purchase certain goods, say ready-made garments from the manufacturer, and I purchase and give him the on-the-spot money, either through cash or through the bank account. That means I am doing the cash purchase. Similarly, I have a cash sales. Or similarly, I have certain income in cash or certain other expense in cash. And these are transactions. Purchase and sale refers to the operating bucket and in the cash activity. If the same transaction, if I carry out on credit, if I purchase the goods and I take it on 90 days of credit, then it is called an accrual transaction, which we normally say creditors or accounts payable. But that is also on the operating bucket because it is a purchase and sales kind of activity. Similarly, I might sell the goods on credit. 90 दिन की उधारी पे मैं किसी को माल बेचता हूँ. That is also an accrual, and we normally call it debtors, or we normally call it an account receivable. Now, having said that cash transaction and accrual transaction, there is third category of the transaction in the business. And question arises, what is that third category? Now, please listen very carefully. When I say there is an existence of a cash transaction, by logic, without speaking, I am accepting the existence of non-cash transaction. Now, for example, if I say in this class, there are all boys, there are all male members. Without speaking, logically, I am also accepting the existence of female members on this planet or on this earth. So similarly, if I'm using the word cash, there is a non-cash transaction, which is also possible in businesses. Now, then you will ask a logical question. What is the meaning of non-cash transaction? Give some example. So let us understand, there are certain transactions, there is no inflow or outflow of the cash. For example, if I pay salary to my staff, then I will give him check or RTGS or cash. There is some outflow of the cash from my business. It is called a cash transaction. If I give it on rent or if I give it on credit, right, then it is called accrual transaction. But say there is a depreciation in the books of accounts. For depreciation purpose, I never go to any shop. I never give them 1,000 rupees and say, give me depreciation worth 1,000 rupees. These are called non-cash transaction, and they normally fall under non-cash category. So just to repeat, a business is nothing but the 3x3 matrix, which is of certain buckets or activities fall under operating activity, investment activity, and financing activity. And transactions are of three types: cash transaction, non-cash transaction, and accrual transaction. Now, cash transactions are those transactions which are merely a book entry in the books of accounts. Right now, then investment activity, as we have discussed, that some company are doing capex, buying plant and machinery, buying land and building, buying certain software. These are all, if they buy on accrual, it will fall into this particular quadrant. If they buy on the cash, it will fall under this quadrant. If I am raising money, it will fall under this quadrant. If I have to repay the loan and have some liabilities after say 1 year, 2 years, it may fall under this particular category. So the business is all about, these 3x3 matrix. So far, so good. If so far, so good is a very basic thing, which has to be absolutely clear, because then your analysis becomes much easier. Because our context to understand, not to prepare the balance sheet, but to analyze the balance sheet. Now, let us give you an example. Whenever you read in the newspaper or in the media or any magazine, any article or any interview, and management says that we wanted to raise capital by way of debt or by way of equity, or we want to repay the debt, then they are basically talking about financing activity. If somebody says that we want to open one more showroom, one more factory, they are basically talking about investment activity. So this is actually the business 3x3 matrix, and these are the transactions and the activity. These are actually get recorded into the books of accounts, and we call them, basically the financial statements. So in a real life, each and every transactions get recorded into the accounting system, right? And at the year end or at the reporting period, maybe half yearly, quarterly, or yearly, P&L account and balance sheets are prepared, which is nothing but collectively a summary of all these transactions are actually captured into these two statements, P&L account and the balance sheet. And we understand the performance of the company. Now the question is, what is the performance of the company? What we really mean by that, right? As an investor or as a businessman, when we say performance of the company, we want to say how much profit I am making, whether I am making a profit, whether I am making a loss, that I want to know. Then whether I am earning sufficient profit, because if I am earning only 7% on my capital, right? Then I should keep my money with somewhere else where I earn even more than 7% risk-free return from say Reserve Bank of India bond. So whether those returns are sufficient or not, all those things will become easily understood with the help of the financial statements. Now, let us move further with this background, right? What are the different type of the financial statements, right? So if you really look at the financial statements are broadly divided into three parts: P&L account, balance sheet, and the cash flow statement. So P&L account is also known as statement of operations, right? It record all the operations of the company: purchase, sales, expenditures, all those things are captured into the P&L account, and it gives you at the end, ultimately, the performance of the company in terms of profit or the loss, right? As you can see, it is nothing but the summary of all your revenue, expense, cost, which are incurred for a particular period. Now, this is very important word for those people, right, who do not have accounting background or a finance background, that this specified period is very, very important word. Why it is very important? Because a P&L account is prepared for a period. It may be a 12 month, it may be a 6 months, or it may be a 3 months, depending on the requirement. Now, why I say depending on the requirement? Say under the Companies Act, management will give you the annual reports along with P&L and the balance sheet and cash flow on the yearly basis. But if you are a listed company, then your performance, that is P&L, you have to publish at least on a quarterly basis. On half-yearly basis, SEBI also requires a listed company to give the P&L as well as balance sheet on a half-yearly basis and the yearly basis. So it is for a particular period that we have to understand, right? Now, there is, in order to understand the P&L account, we have to understand the journey of the P&L account. Now, what we mean by the journey? Now, it is nothing but the angle of the businessman, angle of the analyst, or the angle of the investor to look at the P&L account. Now, P&L account, everybody have a different way to look at. Why I'm saying so? Because all financial statements are meant for the user of the financial statement. So the logical question is, who are the user of the financial statement, right? It can be a businessman. It can be a decision maker within the business. It can be the government like income tax or the GST authority. It can be investor. It can be the bankers, right? So there are various categories of the people who look at the financial statement for a different purposes. So our context is to think as a businessman or to think as an investor. And from that context, we will look at journey of the P&L account. Now, let me share the Excel sheet. Let me stop this and let me share the Excel sheet to understand the journey. Yeah, I hope the journey is visible, right? Somebody has written, click the meeting tab under the meeting basic, webinar chart toggle. Okay. Where to go meeting tab? One second, give me a second. I'm not getting this. Anyway, let me continue with the Excel sheet. Okay, now just have a look at the Excel sheet, this P&L account. And our context is to look at the journey of the P&L account. Now, let us look at the very first line. Is a P&L is always for a period, right? Say here I have written P&L for the period ended 31st March, say 2023. What does that mean? It will cover 1st April 22 to 31st March 2023 for the year ended. If it is for a quarter, then it has been written P&L for the quarter ended so and so. If it is half yearly, then it will be written P&L for the half year ended so and so. So the user will understand very clearly what is the time frame is captured in the P&L account. Now, let us start with this. A very first item in the P&L account is nothing but the sales of the company, right? Because it is a statement of operations. And in statement of operations, sales and purchase expenses are major items, main items. So this starts with the sale and say this is 1,000 crore. Then immediately a question arises in the mind of the businessman or in the mind of the investor. In order to make this 1,000 crore sale, what is the material consumption incurred in this particular period? कितने का माल कंज्यूम किया गया है? And say this is worth say 700 crore rupees. Then immediately a very first milestone in this journey that we will come to know what is the gross profit of this company. So what we get a very clear picture here, that when we minus the material cost from the sales or the revenue, we get a very first milestone that is called the gross profit of the company. Then question arises, after this 300 crore profit, what will happen to this 300 crore? Obviously, I will use this 300 crore in order to meet other expenditures for the operations, because material needs to be processed, right? Say I'm a manufacturer, material needs to be processed. Otherwise, I cannot create a finished goods and I will not be able to sell in the market. Then, in order to process this material, I might have certain manufacturing cost, employee cost, and also in order to sell this material, I will have a sales and certain general and administrative expense, office expense. A manufacturing expense is like consumables, power and fuel, which are using into the factory, right? These are called the manufacturing cost. My laborers, my factory staff, my normal office staffs, etc. This is my employee cost. And SGM is sales and general and admin expense. So I have a sales and distribution expense, logistics expense. These are called the sales expense. Then I have a certain general expense and admin expense, office establishment expense. These are called SGA expenses. These are for part and parcel of my core operations. And when I minus this, plug together all these as other operating expense, what I will get is, say 100 crore is my expense, say hypothetically. Then I am left with 200 crore profit. Now, what does that mean? That I have a revenue or a sale of 1,000 crore and material and other operating expense. When I minus, I get operating profit. What I get? I get operating profit. I get operating profit. Now, question is, the technical term for this EBITDA. Technical term for this is EBITDA. We normally, in a loose language, call it operating profit. Now, the question is, the full form of EBITDA is what? Earning before interest, tax, depreciation, and amortization. That means before interest, depreciation, and amortization, what is my profit? Because now I know two milestones I have achieved in the journey, 300 crore, and after 100 crore expense of operating expense, 200 crore of operating profit. Now let us go a little technical and why it is called EBITDA and what is the significance of the word EBITDA that we have to understand. So as we know that a very simple language, that EBITDA means earning before interest, depreciation, tax, etc., etc. And from this 200 crore, I will minus depreciation and amortization, and then I will minus interest, right? But two questions we need to answer, that what is the significance of the EBITDA, right? And what is the meaning of depreciation and what is the meaning of amortization? These are three questions we have to answer. First, let us answer what is depreciation. Many of you must be aware, whenever you use any fixed assets, right? Plant and machinery, land and building, software, copyrights, etc., through which you conduct your business. Then normal wear and tear happens into the usage because of usage of these assets. This normal wear and tear is technically called a depreciation, right? And this depreciation is normally charged as an expense to the P&L account. Then question arises, what is the meaning of amortization, right? Now, amortization is also technically speaking, a depreciation, but the word depreciation belongs to the tangible assets like furniture, building, car, vehicles, etc., etc. The word amortization is a depreciation only, but it is attached to the intangible assets. Now, then logical question arises, what is the meaning of intangible assets? So intangible assets is nothing but your copyrights, your software, your goodwill, brand, etc., is your intangible assets. When those assets are in your balance sheet, they are also, depreciated over a period of time. And that depreciation technically called amortization. So first point about depreciation and amortization clear. Now the very second question is very important is what is the significance of the word EBITDA? Now, as you have already seen that in business, there are three buckets of three main activity: operating activity, then investments activity, and financing activity. Correct? Now, say there are two company A and company B. Both are, say, in the same business. Say both are, say, in the business of retail. Now, what does that mean? If, say, one company say DMart and another company say Big Bazaar or Future Group, both are in the retail business, right? Then what is the difference between these two companies, right? If you really look at their overall performance, because business is all about these three activities. Though in operations, right, this EBITDA belongs to the operating buckets. This EBITDA belongs to operating bucket. Then your depreciation belongs to the investment buckets, and your interest belongs to the financing buckets, right? So my ultimate performance after deducting everything, right, is actually profit after tax. Now say DMart choose to be a zero debt company. Then in this company, there will be a zero interest charge, interest expense. Say the DMart also decides hypothetically that they do not want to buy any assets and they just want to take it on rent, then in that case also the depreciation will be zero. And say the another company who has exactly opposite strategy under investment bucket and the financing bucket, and they say that we want to borrow, then they will have an interest expense. And they say that we want to buy the showroom, buy the retail shop and stores, and we want to put it into the balance sheet. So they will have a depreciation. So these investments and this depreciation can vary as per the financing strategy and as per the investment strategy of the company. Now, having said that, these operating buckets of the company is something driven by the market forces. Between a similar business, let's say retail business, between Shoppers Stop, DMart, or a comparable business, the operating profit margin cannot vary drastically in a normal circumstances. Say if the Shoppers Stop, say if there's a DMart and say Big Bazaar, both are doing same kind of business of say selling the grains or selling the say grocery in their stores, then their operating margin cannot differ drastically. It will remain in a particular band only in that industry. If it is out there, if there is outlier and it's a consistently you find an outliers, it actually calls for a deep investigation or a deep research in that company, that why that kind of efficiency they are bringing. Now, I am using the word efficiency. Why I am using it, let me put it now, that then you will understand significance of the word EBITDA. See, if you want to understand, let us take an example of India. India, we have to understand in terms of business or analysis. We have to divide India in two parts. India before 1991, India after 1991. Now, why I say so? Because before 1991, there was not much of, globalization and liberalization in our country. And hence, those people, who have seen those days will agree with me that normally it was like, cost plus profit is equal to sale. That was the strategy in those companies. That if you manufacture something or if you buy something or import something, say $100, you add your markup of say $5 and sell in the market at $105 because it was a quota system and not much of competition and restricted economy. After 1991, all of us know, thanks to the Manmohan Singh, thanks to the Narasimha Rao, our economy opened up, right? And global competition came and it forced people to become productive, become more efficient. And the equation has changed from sales minus profit is equal to cost. Now, what does that mean? Let us go very deep into this and pay attention. that sales or a selling price, right, in a competitive environment is not as per the whims and fancy of the businessman. Unless you are monopoly or a duopoly, you have some pricing power. But if you do not have a monopoly or a duopoly, your selling price are decided by the market forces. Hence, selling price is something which is in the hands of the market collectively. As far as profit is concerned, again, your profitability is decided by these market forces, because an abnormal profit, maybe in an exceptional year you may earn, but in the long run, that abnormal profit will not last in a normal case unless you are duopoly or a monopoly. Because a abnormal profits, a very high profits, is like a honey jar. It will immediately attract a lot of competitor, and that will bring down the profitability, and an equilibrium will come. You will come back to the normal profits. So again, the profit is something which is now left in a competitive environment to the market forces. So now the businessmen are left only with the equation, the C part, and that is the cost part. And that is what in the hand of the businessman in most of the cases to work more on their productivity, more on their efficiency, and bring down the cost and improve the margin. Right? And that is where we need to investigate. If we find any outliers, what is that different thing they are doing? Now you will say, Rupesh bhai, aap to sab theory baat kar rahe ho. Give us the example. So say, even at EBITDA level, say you find one manufacturing company has an EBITDA of 7%, and say same industry, another company has an EBITDA of say 10%, or say 10.5%. So huge difference, right? Maybe 40-50% difference. So then you go deep and understand that why it is so. Maybe the first company might be having in their factory a lot of labor and this thing, and the another company is a new company, and they are using a lot of automations and robotic processes, a lot of automation in their business, and their labor cost is coming down. Or maybe they are using a lot of renewable energy, and the power cost is coming down. So because of that, their EBITDA is outlier. So because of that, but that will not last long in a competitive environment, because the people will catch up to match that, and again, the profitability will come to the normal level. So from this discussion, what is the point I am driving home is that EBITDA is such thing in the long run or in a comparable period, by and large, in the majority of the cases, should move in a particular range. Whether the business is run by Tata, or whether it is done by a Birla, or whether it is done by anybody players, EBITDA cannot vary drastically. Hence, in a peer comparison, EBITDA comparison is very, very important thing when you think as an investor. I hope this so far so good, but the point is clear to everybody. Right? The questions we will take later on, even for brand and all these things, right? We will come to that. Let us first complete the basics. So having understood this EBITDA, and say this EBITDA is in our case, the second milestone in our P&L journey, say 200 crore. Right? As we discussed, we will minus the depreciation and amortization and say this is 40 crore. So we are left with 160 crore. Then the interest portion, correct? Say I have borrowed certain money from the bank, or maybe through bonds, or maybe a private party. I need to pay this 20 crore to the bank or to the lenders. So I am left with now the fourth milestone in my journey of P&L, that is profit before tax, and that is 140 crore. Correct? And now, please understand, whether you are an individual, or a partnership firm, or a private limited, or a public limited company, or an LLP, or even a HUF, if you are doing business. I am saying that I am a proprietor, but in a true sense, I am not proprietor. Why I am saying so? Because at least in India, I am not commenting on other country. In India, nobody is individual, nobody is proprietor. You always have one partner with you, and the name of that partner is Nirmala Sitharaman. Correct? At the end of the year, he will always come and will say, where is my share? Right? And that we say taxes. Even if you are individual, she will share your profit, which is known as taxes. So you will pay some amount of tax depending on the tax rate applicable to you. Say hypothetically that is 40 crore. That means the last milestone is 100 crore. So when we look at any business, we have to understand the P&L in terms of these milestones. Because if you really see here, what is the thing in this particular P&L, right, that is the material cost. That is the cost, right? And from there only, rest of the things are flowing. So in every P&L account, when you see, our job is to find out in this journey, right, what are three major costs or top three costs, right, which can make or break the P&L of this company, right? That is where the actual analysis of the P&L or the operations of the P&L can happen in a qualitative manner. Otherwise, it is just the mathematical exercise. I hope so far so good. The point is clear to everybody. Let us move to the presentation again. Now, having understood this, let us move to the balance sheet. A second important component is the balance sheet, right? So what we mean by the word balance sheet, right? So balance sheet is nothing but a statement, correct? Is a statement which tells you about what is your assets, what is your liability, and what is the shareholders' money lying into the company. It tells you about three things. What is the asset of the company? What is the liability of the company? And what is the shareholder money lying into the company? But the most important thing, that balance sheet is always at a particular day. Now just compare with the P&L account. P&L account is for a period, but the balance sheet is on a particular day. It is in a particular point, right? That is why we say the balance sheet as on 31st March 2023 or 30th September 23, 30th September 22. That is how the word as on is always written on the balance sheet. It is on that day, what is the status of the company, that is from the balance sheet. Now let us try to understand these two things, P&L and balance sheet. Let us have a comparative understanding. The P&L actually tells you what is my income, what is my expense, and so what is my profit or loss. And balance sheet actually tells me what is my assets, what is my liability, and what is the shareholders' money lying into the company. So if you really look at from that angle, business is all about these 4 or 5 things. What is income, what is expense, what is assets, what is liability, and at the end, what is the shareholder money. ये सब करने के बाद क्या शेयरहोल्डर का वैल्यू, शेयरहोल्डर का मनी, नेटवर्थ ऑफ द कंपनी वेदर बढ़ रहा है कि नहीं बढ़ रहा है, right? That is the ultimate thing we have to keep in mind. Business is all about these 5 things, which is captured in these 2 financial statements called P&L and the balance sheet, right? And as I said, that it tells you what the company owns and owes, right? There is one equation that in balance sheet, the asset is equal to liability plus shareholders equity. Now, why I say so? Let me just explain you. Say hypothetically, say this is the balance sheet of the company, right? This is called T format. Say this is the liability side and say this is the asset side. Many of you might be aware, but for the benefit of those people, right, who doesn't have this background, please bear with me because this is a very, very basic thing. Say my equity capital is say 100 crore. Say my reserves and surplus. What is reserves and surplus? All the profits and these things which are plowed back into the company year after the year, which I have earned and used in the business. That is called my reserves and surplus. And say that is say 30 crore. And say I have taken say term loan, that is long-term loan. I have taken short-term loan, say cash credit facility, and there is certain current liabilities in my company. So all these put together, say 20 crore. That means what my size of my balance sheet is 150 crore. Now the question arises where these monies are deployed. Now just say this is say in the fixed assets of the company. Say fixed assets of the company are say land and building, plant and machinery, furniture and fixture, right? software, intangible assets, brands, copyrights, goodwill. Say all this put together is say 80 crore. And say my current assets. Now, what do you mean by current assets? My inventory. What is inventory? The closing stocks of raw material, closing stocks of work in progress goods, semi-finished goods, closing stocks of my say finished goods. This is my inventory. Then my debtors, right? Debtors means account receivable. जिसको मैंने उधारी पे माल बेचा है. They are called my debtors. And other current assets. Now, what is other current assets? Something like say prepaid. I pay insurance payment in advance for 3 years. So 2 years I paid in advance. So that will appear as a other current assets. I have given some advances to my employee. I have given advances to the electricity company. I have given advances to the customs and excise department. Or I have some fixed deposits. So all these things will appear here as a cash balance, as a current assets. So that's a 70 crore. So balance sheet always, assets equal to liability. So 150 balance sheet size tallies. Now look at this particular equation. What is the asset? This is the asset of the company is 150 crore. What is the equation? Is the shareholder money? This is the shareholder money. This is 130 plus liability. This is 20 is the liability is equal to 150. That means if we want to rise above the equation, what we try to understand that asset side of the company will actually tell you what the business is all about. It's more like a manufacturing company because more of the fixed assets, right? And 150 crore is deployed in this company and they are financed by 20 crores by the outsider and 130 crore by the owner of the company, that means promoter and the shareholder of the company. And that is actually the idea to bring out the meaning from this equation, right? Now with this background, let us understand the balance sheet, right? In the Excel format. Right? Okay. Now, just try to see, this is 1100 crore balance, some error here. Okay. Say this is 1000 crore balance sheet, correct? Now see on this is called a vertical format. It is always starts with balance sheet as on a particular date, this balance sheet is prepared, right? Balance sheet is on 31st March 2000, so and so, maybe 23, maybe 24, 25, right? Then say equity capital, that is the shareholder money. That is called shareholders money. Now, this is a very long-term source. So whenever we look at the liability side, as an analyst, we also have to think what are the long-term source of money and what are the short-term source of money. So this equity capital is a very long-term source of the money available to the company. And I will tell you as I progress why it is necessary to look at from this angle also. Just park that question in your mind right now. Then comes reserves and surplus. That means my share premium, reserves in share premium account, general reserve, surplus in P&L account. There is my plowback of the profits, etc., etc. These are also the money which belongs to the shareholder and appearing as a reserves and surplus. If you look at current latest balance sheet of any company in India, the terminology uses other equity because now accounting standard has changed and the terminology has changed to other equity. And say, let us say this is 400. And that is also a very long-term source of the money. That is also the very long-term source of the money. Now the question arises, this 500 crore is the long-term source of the money, right? Now, many times we use the word equity, or many times we use the word net worth, or many times we use the word shareholders' funds. Let us understand, these are all long-term source of money. But the very first distinction we have to understand, equity and equity capital, both are different. Equity capital means this 100 crore, which is the equity share capital introduced by the shareholders in the company. When we say equity, equity is actually the net worth of the company. When you use the word equity in isolation, it is called net worth of the company. Now, net worth means what? Equity capital plus reserves and surplus. So in this case, the net worth of the company or equity of the company is 500 crore. So never ever use this jargon, right, without understanding the meaning. When you say equity capital, means it is the actual capital of the company. When you say equity, means it is the net worth of the company. And both are the long-term source of the money. Then say, I have borrowed 200 crore from the bank. So that is, again, you have to think the split, because if you look at Screener actually gives this split between long-term borrowing and short-term borrowing. Now question arises, what is the long-term borrowing and what is the short-term borrowing? Say I have taken a term loan from the bank. That means a long-term loan which is payable after 12 months. Say for 5 years I have taken loan for the purpose of construction of the factory building or buying the plant and machinery, which I will repay more after 12 months, or the repayment period is more than 12 months. That is called a long-term loan. Again, that is a long-term source of finance. But I might also borrow from the bank in terms of cash credit or the overdraft for the purpose of running my day-to-day activity. And that is called a short-term source of borrowing. So borrowings, whenever you look at, also look at what is the long-term amount and what is the short-term amount. Then comes the current liability and the provision. Now, current liability and provision means what? A first logical question you will ask, why these two terminology? Why not only current liability or why not only provision? The word is current liability and the provision. The current liability and the provision both are short-term in nature, which are repayable within the 12 months. That is why it is short-term. But say, let me give you an example. Say I am running a factory of manufacturing of the furnitures and fixtures, etc., etc. And every month, because I am using power and fuel, I get electricity bill. Say on the 31st January, I receive, say, the bill for up to 31st December for the month of December. I have a bill in my hand. I know exactly what is the amount I need to pay to the electricity company. Because the amount is crystallized and I have the bill in my hand, and still it is unpaid, I will call it current liability. But say, after the March, let us take an example. In the month of April, somewhere, say in 20th April, I am receiving the bill for the month of March. And I am preparing, say, my balance sheet somewhere in, say, 7th of April for the purpose of reporting to my board of directors. I do not have a bill in hand of electricity company, but I have consumed electricity in my factory. Now, I cannot say, since I have not received the bill, I will not book the expense, right? And I will inflate the profit. I cannot do that. So what is the solution in my hand? Then I have to look at some logical estimates, that what was the last 11 months average, or what was the production in last 11 months, what was the consumption of the units, what is the per unit consumption. Then I look at what is the unit produced in this March month, and some logical reason I will arrive at some estimated figure, and I will book the expense in my accounts, right, as a provision for electricity. So essentially the difference is what? Current liability means it is a crystallized figure, and the provision means there is some assumption, there is some estimation, right, has gone into arriving at that figures. Having said that, why it is very important? Whenever you see the provision in the books of accounts, in the annual reports, into the balance sheet, and the amount is significant, you should read the notes to the account policies and the reasonings given by the company for that provisions, because here the estimates and the assumptions comes into the picture. And as you know, when subjectivity comes into the picture, is a human tendencies, they might manipulate either on a higher side or on a lower side. And that is why it requires a deep understanding when you analyze the provisions in any company. Because in many companies, you have a provision for gratuity, provision for expense, provision for pension, provision for leave encashment. You even have a provision for guarantees and warranties, right? In a consumer durable company. One needs to understand these things thoroughly, right? And these are basically creditors and the other provisions. And roughly say this is 300 crore. These are short-term source of finance. So if you really look at 1,000 crore is the size of my balance sheet. In this balance sheet, if you really look at, say 500 crore is a long-term source. Say my long-term borrowing is 100 crore and short-term borrowing is 100 crore example. So 500 plus 100, 600 crore is coming from the long-term source, which have a life of more than 12 months. That gives me the meaning out of this when I try to look at it in this fashion, which will help you as you go deeper into the analysis of the financial statements. Then the question arises that I have this 1,000 crore source available. I have already raised this 1,000 crore, or I have this money. Next question arises as an analyst, where I have deployed this money, right? Now just look at, first is the fixed assets, land and building, plant and machinery, furniture, etc., etc. Right? It is always classified or presented in this manner that gross asset is 650 crore, gross block, right? Gross block. It is called gross block. That means original cost of all the assets. The meaning of this means what? Original cost. This is nothing but original cost before depreciation. Actual original cost before depreciation. Right? I might have purchased some assets 10 years before, some assets 5 years before, and some assets in this year also. Right? All this put together, the original actual cost is 650 crore. Then what is the total depreciation I have already charged, right? On those assets, say 200 crore. So this is called the WDV. This is called the written down value of the assets, that is say 450 crore. And say capital work in progress is 50 crore, that means 500 crore is my actually long-term utilization of my money. Now, first point we have to understand what is CWIP. What is the capital work in progress? Now, capital work in progress means I am constructing the factory building, example, and say it will take 3 years. So at the end of the 1 year, whatever the cost I have incurred, right, under construction, right, that is called the capital work in progress, and it will appear as a line item into this particular balance sheet, right? Similarly, any assets, right, which is not yet put to the use, it is under construction or it is still, not yet used, and they are, because of some reasons, it is not yet completed, they appear as a CWIP. So what you understand that out of this 1,000 crore, 500 crore is say from long-term source, and the borrowing of 100 crore is long-term source. So 600 crore is long-term use, and of this 600 crore, 500 crore are put into the fixed assets, which is also the long-term use. Right? Now, why it is very important to understand as an analyst, that there is a cardinal principle in finance that my long-term money should be used for long-term source. Long-term source money can go into the long-term usage or into the short-term usage. Let me just write here source and use. My long-term source can go into the long-term and can go into the short-term use, can go into the short-term use. But if I have a short-term money, it cannot go, it should go only into the short-term. My short-term money, which is repayable within the 12 months, should not be used for the long-term purpose. If that happens, then company might go, chances are very bright, might go into the asset liability mismatch. When the maturity comes, they may not have the liquidity and they may default on their obligations. So when you analyze the balance sheet, always look at this particular angle, that how the utilizations are happening. Whether long-term sources are going into the long-term and short-term, it is okay. The short-term source of the money should never be utilized for the purpose of long-term purpose. For example, if I take a loan from the bank, which is repayable within 12 months, and if I put that money for purchase of the plant and machinery, right, and the plant and machinery might take time to go into the up and running conditions and generate the revenue. say it take more than 12 months, and within 12 months, if this loan is repayable, I will be in big trouble because I will not have a cash flow. I will not have a money to repay this loan. So this is a cardinal principle in the finance, which we have to understand very clearly when we look at the balance sheet of the company. Then say investments, right? Maybe the company might have something in mutual funds or in shares or in debentures or some short-term surplus, long-term surplus are kept here. That is investments. Then a current assets. What we mean by the word current assets, right? Just like current liability, which is repayable within the 12 months, is called current liability. Current asset is exactly the same, which is realizable within 12 months, is called current assets. That means my inventory, as we discussed, my debtors, accounts receivable, and other current assets, these are 480 crore. That means this 1,000 crore, out of that, 480 crore is into the short-term use. And if you really see, these 300 crore and 400 crore, right? These are short-term use. These are entirely going for the short-term purpose, and balance 80 crore coming from the long-term use. So this is a structure of a balance sheet, which is a very, very prudently structured balance sheet where it can absorb certain external shocks or internal shock or liquidity issue comes, this company can survive. So that is the angle of to look at the balance sheet, right? So let me see some comments here. When the CWIP shift to the gross block, if there any condition, okay, CWIP taken in the see CWIP, when my factory is completed and I put to the use, that year I have to take it to the gross block. That is called a capitalization of CWIP, right? Okay, let's go to the presentation of it. Now, having understood the balance sheet, let us talk about the cash flow. Now, what is the cash flow, right? Because as we say, the financial statements, we normally say there are three financial components: P&L account, balance sheet, and the cash flow. But it is very interesting that cash flow is actually a product of P&L account and the balance sheet. It is a product of P&L account and balance sheet. Now, before we go to the cash flow, there are few basic questions we have to be very clear that first question is what is cash flow? Second question is what is the importance of the cash flow? And third question is how to analyze the cash flow. These are three important questions which we have to be careful. Let us first, before answering these three questions, let us first understand the statement which is visible on your screen. What is cash flow? Or what is the importance of this cash flow? Say sale is vanity, profit is sanity, and the cash is reality. Now, what does that mean? Vanity means what? Ego, right? We see many businessmen who keep talking, no, हम 5,000 crore का turnover कर देंगे, 50,000 crore का turnover कर देंगे. Especially when I go to north side of India, with due respect to all the friends, who are from the north side of India, I see that people say, हम market में आग लगा देंगे, हम ये कर देंगे, वो कर देंगे, इतना sale कर देंगे. When the businessman talks purely from the angle of the sales, and there is no mention about profits, no mention about cash flow, or rather no understanding about that. You have to understand very qualitatively, right? That he only talk about, it's an ego. It's kind of operating leverage is ego. He's operating from the ego. बस मुझे इतना sale कर देंगे. And उसको ये नहीं मालूम है कि profitable sale होगा कि नहीं होगा. So when anybody talks only about the sales, you have to understand we only talk about trying to satisfy the ego only. Profit is sanity. Sanity means थोड़ा अक्कल का काम है. Sanity means थोड़ा बुद्धि का काम कर रहा है. But the guy is talking about sales which is profitable. So if I want to increase my sale, a good businessman or good investor look at, is it a profitable sale? Because simply increasing the sale does not mean that my profit will go up. Now, we have seen in case of, say, before Corona, or there were boom in the aviation sector in India, Indigo and SpiceJet, and all those companies were having a very good volume, right? And airports were looking like a railway station, huge volume. But very few airlines were actually making profit. You've seen the case of Big Bazaar, huge volume, huge ramp up, but at the end, profitability was missing, right? But you see the DMart, sales along with sales, profit is also growing, right? So कोई बंदा अगर profit की बात करता है, along with the sales, then he's talking some sense. थोड़ा अक्कल का बुद्धि का बात करें. Now the question arises, even profit alone is not enough. Along with profit, this profit should realize and should come into my bank account. Now, why I'm saying so? Because I might sell, say, 100 ton of chemical, 1000 ton of chemical, and say the value is 1000 crore, and say my net profit margin is 10%, and say that means 100 crore is my profit. But my customers are not paying me. Many are in disputes with me. Many are went bankrupt. Many exports I have done in African country and I'm facing country risk and monies are not coming. Many export I have done in Ukraine and European country, and because of war, there is a freeze on those country and foreign exchange are not coming. So मेरा 100 करोड़ का प्रॉफिट दिखता है, लेकिन मेरी बैंक में कुछ नहीं आ रहा है. तो ये प्रॉफिट का कोई मतलब नहीं है. That is why it is said cash is reality. Now, what I mean by cash is reality? Ultimately, my profit should realize and sit into my bank account. And that is why we analyze the cash flow. Correct? Everybody clear? Now I will again revisit the original framework which I have given in the beginning. That business is nothing but the 3x3 matrix from our perspective. Say my operating buckets, my investments bucket, and my financing bucket, and my cash transaction, non-cash transaction, and accruals, right? So when I actually neutralize this thing, or I exclude this thing, then I'm only left with the cash column. And this analysis of cash column in operating bucket, investment bucket, and financing bucket is nothing but the cash flow of the company, right? This is the visual understanding of the cash flow and the importance of the cash flow. Now, the next question arises that why cash flow is so important, this statement is so important. Because the cash flow is actually a product of P&L account and the balance sheet. You can fudge the figures in the P&L, you can fudge certain things in window dressing into balance sheet, but when both are merged, it is extremely difficult. I will not say impossible, but you need a tremendous amount of financial engineering to manipulate the cash flow. If you manipulate your P&L, if you manipulate your balance sheet, but when you merge these two things and create the cash flow statement, and if you are able to analyze the cash flow statement, तो चिल्ला चिल्ला के बताएगा किधर प्रॉब्लम है. It speaks to you. It's like loud and clear. There is a problem in either in operating buckets or in investment bucket or in financing bucket or in all the buckets. And that is why cash flow statement analysis is the thing. Without understanding of the cash flow, no analysis of the business or a financial statement can be completed. So far, so good. Now, let us deep dive further and try to understand a different angle that what is cash flow. Now, in many our weekly meetings in Diamond Group, many times, I have discussed this, but I will go today in a much deeper, in a clear manner. That let us look at this, that say on 1st April 2021, say my cash and bank balance is say 100 crore. And say as on 31st March 2022, say my cash balance is say 150 crore. So what is the delta? That means the change in cash and bank balance plus 50 crore. Plus 50 crore. Right? Now, what is the mistake people make when they look at the cash flow? दे से भाई इसका कैश बैलेंस 50 करोड़ से बढ़ गया है, that means it is very good, right? A net cash positive is very good. That is the biggest mistake, we all of us make. This is actually optical illusion. The story might be different because the meaning of the cash flow is that what is the reason? What is the reason that balance has gone up from 100 crore to 150 crore? Why it has gone up? What is the reason behind this increase in 50 crore? That reconciliation, that explanation, that story is actually the cash flow. This 50 crore increase may be a good thing. This 50 crore increase may be an extremely horrible thing also. That we have to be very, very clearly understood. And we should never judge anything from this figure. I hope so far so good. Now, why I'm saying so? Let us deep dive into this. Now, let us say, yes, company A and company B. Let us take two companies, right? And just pay the attention that sale of this company is say 1,000 crore, and say profit before tax of this company is say 100 crore, right? Now let us arrive at the cash flow of this company, cash flow statement, right? Now say cash flow from operations of this company. If we arrive at what we do, profit before tax, 100 crore. Then we will add, say, all the non-cash item and provision, depreciation and all those, etc. Say this is 10 crore. Then I will minus interest income, other income, because this is not my operations. This is other income. This is not, say, मेरा FD से interest आ रहा है, तो मेरा कोई business FD में पैसा रखने का नहीं है. ये temporary sector. So interest income or other income is not my operations. So I deduct and say that is say 30 crore. Correct? And say change in the working capital, right? Current assets minus current liability of the last year in the current year. मतलब मेरा working capital में कितना पैसा जाम हो गया, market में कितना पैसा जाम है as compared to last year. And say roughly say this is 100 plus 10, 90, 90 minus 30, 60, and say 80 crore मेरा जाम है. That means minus 80. What is the cash flow from operation? Minus 20. Cash flow from operation. Right? Now just see the story of this company, that 1,000 crore turnover, 100 crore profit, but in the operation it is bleeding. Why? Because working capital में पूरा कंपनी का जान निकल गया. Right? या तो डेटर पैसे नहीं दे रहे, या तो क्रेडिटर पैसा मांग रहे हैं. इसका साइकिल इसके फेवर में नहीं है. डेटर क्रेडिटर साइकिल, इन्वेंटरी साइकिल इसके फेवर में नहीं है. Maybe is inefficient, that we need to check, or maybe the business model is like this, the industry is like this. That is a qualitative part of it. The reason, to find out a reason is a separate thing, but right now it is very clear that this company is bleeding into the operations. Now let us go further and say this cash flow from operation is minus 20. Now say the board of directors says that since you people are not making any money into the operations, we will not allow any capex, and say the capex is 0, right? So the free cash flow is minus 20. This is called a free cash flow. Free cash flow, say minus 20. अब ये 20 करोड़ का नुकसान है, डेफिसिट है, तो टेक्निकली पैसा तो कहीं से लाना पड़ेगा ना. It is not just mathematics. Business is not just mathematics. You need to bring this 20 crore from somewhere. Otherwise, you will default and you will die. And you will get a natural death of this company. So promoters will go and raise debt from the bank and say, we call it cash flow from financing. And say they raise the debt of 70 crore. Say. And that is how they have plus 50 crore of change in cash and bank balance. Right? So 50 crore का cash and bank balance बढ़ गया. But इसका story तो horrible है. हम क्या बोलते हैं, 1,000 करोड़ का कंपनी में 100 करोड़ का प्रॉफिट है, ऐसा कंपनी किधर मिलेगा? But if you see this cash flow from operation is bleeding, and if that story continues year after year, or in the historically also this continues, तो a dangerous company. We have so many options as an investor, right, to manage our risk and invest our money in such companies where our risk is actually less. Because investment is all about taking less risk and maximizing the profit. That is actually the investments, right? Otherwise, a lottery fetch ke bhi, higher risk ke bhi, you can become millionaire if you are lucky. Now let us look at this company, company B. Say sale of this company is also say 1,000 crore. Say his EBT is also say 100 crore, right? And now let us look at cash flow from operations, cash flow statement. Say cash flow from operation, let us work out. Say is profit before tax, say 100 crore. Say his non-cash depreciation provision, say he's also 10 crore. Say his other income is also say 30 crore. Correct? So here also this is 60. But say here he is managing the working capital well, right? And what is actually going is say 20 crore. That means he has a 40 crore of the cash flow from operations. This is the first point of difference between these two companies, assuming both are in the same business and same level, hypothetically, same level of operations, same market, same region, everything same, hypothetically. Now these companies making 40 crore into the operation. And say the board of directors decides to do some capex. तो बोला चलो ये management अच्छा है, employee अच्छा है, market भी grow कर रहा है, चलो और 10 करोड़ का capex करते हैं. So 10 crore will, और से चलो एक बोलते हैं 20 करोड़ का capex करते हैं. तो अभी इसके पास free cash flow 20 crore का. And they say that, let us, have some, raise money in advance for your future growth. And say they raise 30 crore from the bank. So there, these 20 plus 30, delta is 50 crore. You see in both the company, the delta is 50 crore. But in case of company A, the story is horrible. And in case of company B, it is a fantastic, it's a dream story, right? So one has to look at for investment purpose, right? Dream company. And that is why this statement that cash is the reality, right? This is what is ultimately very important when you talk about the cash flow. So far, so good. Correct? As we have seen this, there is an operating cash flow, there is an investment cash flow, and there is a financing cash flow. So somebody is asking, sir, you need to add non-cash 100 plus 10. Yes. Yes. So non-cash 100 plus 10. Yes, we need to add. Now, this is expense, we need to add back. Okay. Now let us read that. And now having understood the P&L, balance sheet and cash flow, with this basic understanding, as an investor, our ultimate aim is actually to analyze the financial statement. Now the question arises, why? Why we analyze financial statement? Correct? So this is the answer. Correct? As an investor, first we would like to know the profitability about this company. That what is the profitability? What is the profit of this company? What is the profitability of this company? And that is where understanding of P&L becomes very, very important. Because now we know the journey of the P&L. Right? In our case, we have seen gross profit, gross margin, we have seen EBITDA margin. Because when you divide by the sales, all of you know you get the margin percentage. So you know what is gross margin. So that is called profit. Gross margin is the profit. Gross profit is the profit. And when you say gross margin means you arrive at the percentage dividing by sales. Correct? So you understand the profitability of the company in terms of gross margin, in terms of EBITDA margin, in terms of PBT margin, in terms of PAT margin. That gives you a very clear understanding about the operations of the company. Then you also would like to know, what is the liquidity, right, of this company. That means whether in the short term, company will be in a position to repay the obligations which are maturing within 12 months. Is there, do have enough liquidity? And that is why our understanding of the balance sheet becomes very important. There are various ratios for this, like current ratios and quick ratios and etc. etc. We also want to understand in analysis the solvency of the company. जब ये लॉन्ग रन में सॉल्वेंट रहेगा ना, NCLT में तो जाएगा नहीं ना, insolvent तो नहीं हो जाएगा ना. That is also we would like to see. And that is why, and what is meaning of the solvency? Solvency means what? Whether company will be in a position to meet all its long-term obligations, right? From its profits, from its revenue, right? And long-term sources. मतलब क्या वो अपना लॉन्ग टर्म कमिटमेंट पूरा कर पाएगा? अगर 5 साल के बाद लोन रीपे करने का है, क्या वो कर पाएगा? Right? When it's question of a long-term commitments, long-term obligation, when the answer is yes, the company is able to or will be able to repay, then we say company is likely to be a solvent in the long run. And that understanding comes from the balance sheet. And last, as an investor, right, we would like to understand all these things put together along with the cash flow. We would also like to understand the future of the company. And that is why we use our qualitative part of the analysis along with the balance sheet and P&L and cash flow. That is the 4-cylinder model, earning drivers, mega trend, etc., etc., and try to see what is the future profitability of the company. With those assumptions, we try to create projected P&L in the balance sheet and try to arrive at what could be the future profits and what could the multiple market can give and what could be the CAGR return we can make. So that is the angle of the investor, right? Now, for that, one of the important tools, apart from the cash flow analysis, is the ratio analysis. Now the question arises, what is ratio? That is the very first basic and fundamental question. What is the ratio? If you ask me, technically speaking, ratio is nothing but Raj Kamal Bothra. Can you explain again how you arrived at 60? 1 minute, Raj Kamal. Which 60? This, right? See, 100 plus 10, 110 minus, sorry, this is 80. Yeah, my mistake. This is 80 and say this is minus 60. So, yeah, sorry, this was my mathematical error. So is this clear now, Mr. Raj Kamal? Okay. So let us move the ratio. The question arises, what is the meaning of ratio? Now, ratio means what? Ratio is nothing but a relationship between two numbers, right? Those numbers both the numbers can come from P&L account, or both the number can come from the balance sheet, or one number can come from P&L, other can come from balance sheet. But basically, it is the relationship between P&L and the relation between two numbers. That is ratio. Now, ratio, actually, if you observe very minutely, ratio is one thing which exists in every field, most of the field. It is not that ratio we find only in the finance. The ratios are available everywhere. Like if you watch IPL, right, we find no current run rate, asking run rate, nothing but the ratio. If you go to the laboratory and do your blood test or cardio test or any test, right, your sugar level, your BP level, your cholesterol level, anything you take, right, it is also a statistical measure which is used in the field of medical. So the ratio exists everywhere because it tries to relate two numbers and bring out meaning out of it. That is actually the ratio. Now, having understood this, what are the important ratios? Broadly, it is classified into 4 types of ratios. One is profitability ratio. Second is a leverage ratio. Third is liquidity ratio. And fourth is the return ratio. Now, profitability ratio, as we have seen the journey of the P&L, and in a case study, we will see that all these ratios, we will do 2 case studies, and then we will see that gross operating profit margin ratio, net profit margin ratio, PAT ratios, yeah, all those things. Leverage ratio. Now, what is the meaning of leverage? Let us first understand the meaning of word leverage in the context of the finance. The word leverage, ये कहाँ से आता है? Actually, the word leverage is coming from the physics, right? Now, leverage means what? Say, if I have to lift some object and say I lift this glass, right? Or say I lift this one object, some object with my hand, and I have a capacity with my hand to lift say 20 kg. That is my natural capacity. But say if I put a robotic arm in my hand here, then my capacity to lift might be say 1000 kg, maybe 500 kg. So I am using some external power, right? And increase my capacity. That means I have leverage. That is called a leverage. Using an external power is called a leverage. So how the leverage is used in finance? Say I have 100 crore with me and I put it as equity capital, right? Then I might be able to do say turnover of say 200 crore, say for example. But if I go to the bank and tell the bank that this is my 100 crore, on that you give me 150 crore. So now I have a 250 crore and I am able to do a business of 500 crore. So I have used the leverage of 150 crore. That means an external money power from the lenders, right? And I have increased my capacity to do the business. And that is called a leverage. But leverage, one has to be very careful that leverage to some extent is okay. A leverage beyond a point can become very, very risky, very, very risky. When cycle turns against you, it can even kill you as a business. So too much of a leverage is very risky. And that is why in finance we say, in analysis we say, when debt equity ratio is extremely high and not supported by the interest coverage ratio, right? Then we say that the risk in the company is extremely high, even if it is a profitable. And what we have seen in the case of Adani and all those companies, that where as a group, they have more than, I think, 2 lakh or I don't remember, but a huge debt and their cash flow, right, to repay was very, very meager, right? And in the past, we have seen many such Kingfisher Airline and many such companies who went into NCLT because of the leverage. So what the point I'm trying to draw here, many times the business is good, but because the balance sheet structure is not good, because of the excessive leverage, right? One unfavorable event, maybe however small the probability is, but if that triggers, right, it wipe out the entire business. And that is why the leverage becomes very important. Now, having said that, leverage, debt equity ratio, interest coverage ratio, DSCR ratio, these are many ratios which analysts use to understand the impact of the leverage on the business. Third is the liquidity ratio, right? As we say that for short-term purpose, to check the liquidity, whether in short term it will be able to repay the loan or not, we look at liquidity ratio. And what this liquidity ratio tells all about? Current ratio, the acid test ratio, that means liquid ratios, these quick ratios, these are all tells you that whether in the short term company is in a position to repay the debt or not. That's short-term liability of them. And last but not least, and the most important for investor also, is the return ratio. Because whether company is earning decent return, right, on the capital employed and on the equity or not. Correct? Now, say as in our Technofunda community, we are very clear that if company is not able to make 15% return sustainably in the long run, or in future also it doesn't look like, right, it's fall below our standard, right? Because in India, 15% return as an investor we want. Because anyway, my opportunity cost, if I put my money in the Nifty in the long run, it gives me 15%. Correct? So here, if somebody wants to invest in the company which is not even making 15%, he should ask himself a question: why is willing to take the risk, right? And there are various return ratios: return on capital employed, return on equity, all right, return on invested capital. There are many such ratios. So that also we look at. Now, having said that, now let us go to the case study and try to, apply all these things and connect the dots, right? So that before I move to the case study, anybody has any question? If I miss out, you can type in the Q&A box, because I don't know how to activate the chat, but I can see your Q&A box. So if anybody has any question, before I move to the case study, we can take 5 minutes to answer those questions. Operating leverage, okay. Suvendu Paul, okay, operating leverage. Okay, I will touch upon that. Now, in a very, very simple terms, there are 2-3 ways to look at operating leverage. The one is a theoretical way, which you find in corporate finance books, right? And one is a practical way. Let us first deal with theory. Operating leverage is nothing but a change in operating profit divided by change in my sales. That is called operating leverage. If you read any literature on finance, we will use this formula. But we are not interested in theory. What we are interested in, true meaning of it as an investor or as a businessman. So if you look at the cost in any organization, you can also look at from the angle of fixed cost and variable cost. Correct? Now, variable cost means what? This cost is proportionately increasing or decreasing with the increase in units or decrease in units. Say, for example, material cost. Say, I am a ball pen manufacturer, and in one ball pen, say 10 kg, say 10 gram of plastics are used, and say cost per gram is say 10 rupees. Say that means what? 100 rupees worth of plastics are used in my ball pen. Example. So in that case, if I produce two ball pen, my cost will be 200. If I produce 3, my cost will be 300. So it moves exactly in proportion with the change in the level of activity. That is called a variable cost. But in business, you also have the fixed cost, right? Say the rent I am paying for my factory, salary I am paying to my employees, right? Even I produce 0 unit, I have to pay salary. Even if I produce 0 units, I have to give a rent to my landlord. So there are many such fixed costs into the company, correct? So operating leverage concept is actually centered around this fixed cost. Now say, let me just remove all these things. Now say my fixed cost in the company is say 10,000 rupees. And say my current level of operations, say my production is say 1,000 units. Say 1,000 units, correct? And say my variable cost per unit is say 15 rupees. Say 15 rupees. So what is my fixed cost per unit? Fixed cost per unit. 10,000 divided by 1,000 means 10 rupees. Correct? So what is my total cost? Variable cost per unit plus fixed cost per unit. That means this 15 rupees plus this 10 rupees. So 25 rupees is my per unit cost. Right? Now say my production goes from 1,000 to 2,000 units. 1,000 to 2,000 units. Correct? My variable cost, in this case, my variable cost per unit will remain 15 only. Her unit mein to 15 rupees lagne wala hai. In totality, it will move in proportion. But my this 10,000 will remain constant, and it will be used by these 2,000 units. These 2,000 units. Right or wrong? So this cost will come down to 5 rupees. So my fixed cost will be 5 rupees. So my total cost will be 20 rupees. That means what? Whenever say this is my total cost per unit, say this is my volume, and say this is my total cost per unit. That means as my level of operation goes up, my total cost per unit comes down. Right? My total cost per unit comes down. Right? And this is called operating leverage. So if my selling price say is 50 rupees, right? Then in first case, it is minus 25, profit is 25. In second case, my selling price say remain the same, but my cost per unit comes down to 20 rupees. My profit will become 30 rupees. That means, my profit per unit goes up because of operating leverage. So in nutshell, when my level of operation goes up, my fixed cost actually per unit comes down. so my profitability goes up. That is actually the operating leverage. I hope that makes some sense for you. Suvendu, right? Okay, what is coverage ratio? Okay. I think somebody is asking, Rupesh bhai, can you just give quick overview of profitability? Okay, profitability. Okay, let me then I will share the presentation or the Excel sheet. Okay, let us look at P&L. Now just see here in this case. Okay, this say 300 is the profit. What is the profitability? 300 divided by 1000. That means 30%. That means 30% is the profitability. Sorry, 30% is the profitability. Here 200 divided by 1000 means 20% is the EBITDA margin. EBITDA profitability is 20%. EBIT is 160 divided by 1000, right? And here 140 divided by 1000. And in PAT, it is 10%. That is my profitability. Now, why we look at profitability? Because profitability will tell you the robustness of the business model. If consistently the profitability margins are constant or sustainable or increasing or steady, that we want to look at. Because many times company grows, right? But their profit margin substantially comes down. Then it is very clear that they are compromising in the profit and trying to increase the volume, right? So when you say the word profitability, you actually talk about the percentage. Is this clear, Vivek ji? Yeah. Now Vivek, okay. Then Ashok ji asking is what is coverage ratio in the bank? Now coverage ratio means what we are talking about. That if my interest coverage ratio means if I'm trying to say my interest cost is say 10 rupees, and say my profit, my EBIT, right? That means earning before interest and tax is say my 100 rupees. So my interest coverage ratio means what? 10 divided by 100, right? Sorry, it is 100 divided by 10. So it is 10 times. It is called 10 times. तो मुझे 10 रुपए का इंटरेस्ट भरना है, बट उसके पहले मैं 100 रुपया कमा रहा हूं, तो आई एम कवर 10 times. That is called interest coverage ratio. Is this clear, sir? So why this is very important? Since you have asked, let us go deep into this. Why it is very important? Because many times what we think that high debt is bad. We think high debt is bad, but that is one side of the coin. If this high debt, along with the reasonably good or a high interest coverage ratio, right? Then it tells you that optically it looks very high debt, but company business model is such that before paying interest, it is having a very good EBIT profit available, which can take care of the interest. So it is not necessary that high debt is always bad, unless you look at the interest coverage ratio, right? It's a good question, sir. Then Shakti ji is asking, sir, should we take CFO on a face-off it because it might be huge interest expense which we have added to arrive at CFO. So when you add up interest, correct, and then you arrive at the CFO, so operations you are doing well, but when you minus the from the interest and everything, and you also see, then you see that for shareholders, what is the amount available. So in that case, you should look at free cash flow available to the shareholders, right? Or you minus the interest and see what is the cash flow after the interest. Technically and theoretically speaking, interest belongs to the financing bucket, hence in cash flow it doesn't come. But for investor, if you find a very heavy debt company, make that adjustment of interest and see how much left for the shareholder, and then take a call. Very good question, sir. I have not expected that such a good questions will come. I was told make it a very basic, but I'm very happy. Can you please explain the cash flow of the two companies taken as an example during cash flow analysis? Anirban Singh. We will take some different two company, but if you want that company to be discussed separately, two different company we will take. Otherwise, we can even interact or offline also if you have two specific company in mind. Give some idea about the revenue. Rohit ji, we'll cover in the case study. High ROC even if the PAT is low? Yeah, possible. See, it's a very good question. Mordhwaj Chaudhary ji is asking, if my PAT margin is very low, can my ROC can be high? Yes. See, retail business, say DMart, PAT margins are very low. Let me open some screener here. Then we'll realize. Let us look at, say, DMart, Avenue Supermart. Avenue Supermart, and let's go to the, first, let us go to the profit and loss account. Just see what is their net profit, 1492. And what is their revenue, 30,000, correct? So what is their margin? 1492 divided by 30,000. Give me a second. 1492 divided by. So their margin is 4.9%. Their margin is only 4.9%. Okay, let me share. I forgot to share this screen. Sorry. See, the Avenue Supermart, see their profit is 1492, their sale is 30,000. So roughly 4.9% is their margin. It is very less. Let us look at ROC. See, their ROC is 16%, which is very good. And I will come to that, right? I will come to that. It is possible. Since you have asked this, let us take this right now only before case study. Let us open the Excel. Okay. Now please understand that what is return on equity. What is return on equity? It is the PAT divided by the sales. So far, so good. Now you can mathematically divide this PAT divided by sales, multiply by sales divided by assets, multiplied by assets divided by equity. This is the formula. If I put it in a more simpler manner, say PAT divided by sales, then say sales, multiplied by sales divided by assets, and multiplied by, say, assets divided by equity. So far, so good. Assume this is, divided by, multiply and divide. Correct? Now, say my sale is, say, 100, and say like a DMart, my profit is 4. So 4% is my actually the profit margin. My sale is 100, and the total assets in my business, right? Total asset in my business is actually, say, 200. Say one. Okay, let us say 200. Correct. So what actually it gives me? 4 divided by 200. It actually gives me 4 divided by 200. This is my return on capital employed. 4 divided by 200. So my return on capital employed is 2%. Is 2%. Correct? So let me just try to take from here 4 divided by 200. It is 2%. Correct? But say assuming that my total asset is only 80. Correct? Say I need less amount of, I am a not asset heavy company, and my assets are less in the company, then my return on capital employed is 5. Assuming that this is only 50, it will increase to 8. So here where the business model of the company comes into the picture. It's asset heavy or asset light, vis-a-vis profitability of the company. That drives the return on capital employed. And now, say come to the return on equity. Say my asset is, as you know, is 50, and say my equity is only 10. So that means what? This is 5. So when you multiply this 8 into 5, you get return on equity. So my return on equity is actually 40%. Is actually 40%. Because my इक्विटी मल्टीप्लायर इज 5 बिकॉज मेरा 10 रुपए का इक्विटी है लेकिन मेरा एसेट 50 का है, 40 रुपया मैं बाहर से लाता हूँ. So the performance is driven by these three buckets. This is PAT upon sales is operating bucket. Sales upon asset is my investment bucket, which talk about my efficiency. And asset upon equity is my financing bucket. And it actually talks about my equity multiplier. Sales upon PAT upon sale is the operations of the company. Mostly this is under the control of the chief operating officer of the company. Sale upon asset is an investments, right? What CapEx company want to do. Mostly it is in the hands of the CEO of the company or the board of directors of the company. And financing bucket, equity multiplier, kitna paisa kahan se lana hai, right? To fund my total assets. Equity se kitna lana hai, debt se kitna lana hai. That is the prerogative of the CFO of the company. And these three, multiplication will drive your ultimate returns. So you might have a low margin company, but high return on equity company, and vice versa. So that is driven by these three buckets. I hope I have answer your query. Cash flow is many times negative in balance sheet of the many company. So what does that mean? They have removed money from the, see, not necessary. Net cash might go up, might increase. Your focus should not be in the net cash flow. Your focus should be in these three buckets: CFO, cash flow financing, cash flow from investments. What is happening in these three buckets? Don't try to guide misguided by the delta or the net change. It may go up, go down. But always prefer a company where cash flow from operations are positive or likely to become positive. Right? That is the sign of a good businessman. Cash flow is many times, okay, sir, can you explain the difference between free cash flow and operating cash flow? Okay, brilliant. See, operating cash flow as cash flow from operations, right? As we say that profit before tax, then you add non-cash item, then you minus all your other income, and then you adjustment for change in working capital. That gives you cash flow from operations ultimately. That gives you ultimately cash flow from operations. When you minus the capex from this, what you get is actually the free cash flow. What you get the free cash flow. Right? I hope, Mudulji, this is clear for you. Friends, screen sharing, okay. ROC and ROE, okay. I request you to once more explain the cash flow slide where you show the one company is having negative. Okay. You want to understand that again, okay. So let me just try to do it here, in the Excel. That becomes very clear. Say company A. Say the sale is 1,000 crore. Say PAT, say PBT is say 100 crore. Now we want to work out cash flow. So we start with PBT, right? 100. Then we will add non-cash item. Say non-cash item is say 10. So what it gives us? 100 plus 110. Then we will deduct the interest other income, right? Say this is minus 20. We deduct them. So what we will get? 110 plus is 90. Correct? Now we will try to bring change in working capital. Difference between current asset minus current liability, difference between 2 years, and say मेरा पैसा जाम हो गया है, and say my 110 crore got jammed into the working capital. So what is my cash flow from operation? Minus 20. This is my cash flow from operations. Right? Now I have to talk about my cash flow from investments and say I am doing capex of say 5 crore, minus 5 crore. So in this case, my free cash flow is what? Minus 25. Correct? And this deficit I have to fund. So in my financing bucket, I will borrow. Say I borrow 30 crore. So ultimately my net cash is what? 30 So 5 crore is my net increase in the cash. So this is the story of the one company. Let us take story of the another company in the same industry. Say 1,000 crore, says at right, and say this is 1,000. Say non-cash is 10. So the 110 is the balance. And say operating income is also the same. So hypothetically, so you arrive at 90. But it is very efficient in working capital. Say instead of minus 110 crore, what is actually getting blocked is say 90 crore. That means what? In this case, you have 40 crore cash flow from operations. The difference is change in working capital. And this company is managing the working capital well, right? Then say cash flow from operations, say this company also does say some amount of say 10 crore of capex, right? Then it has a 40 minus 10, 30 crore free cash flow available to the company, right? And say this company decides to repay the loan of 25 crore. Then what happens? It has the 5 crore of net change. What is the story of this company? What is the story of this company? Company B, that it is managing the working capital well. It is also on the growth path, doing the capex, and they are repaying the loan also. Now just see even the, from the 4-cylinder perspective, debt repayment, capex, revenue, all things are also captured if you look at very carefully. But this increase in the phi is something optical illusion, which should not drive your decision. What should drive your decision is in each bucket what is happening. In each bucket what is happening. I hope, Mridulji, this point is clear, right? Regarding debt equity ratio, the times to maturity of the debt is not considered so 1:1 ratio, but it mature 1 year versus another 2:1 if it in 10 years. Which one is better? See, the point is longer the maturity, that much repayment will come later, right? It is always preferable. But that doesn't mean that your higher debt equity ratio is always good, because your interest accrual on accrual basis, interest will always come into the P&L account every year, and your interest coverage ratio should be good enough, Sudhirji, otherwise you will be in trouble. Then, which metrics is better, return on equity or return on capital employed? Both are equally important. For the company level, ROC we look at, and for the investor and the shareholder level, we look at return on equity. So both are equally important, but from which lenses you are looking at, that becomes very important. In EPS, we take into account not equity, but equity capital, number of equity shares, right? Yeah. Okay. You cannot judge company by only 1 or 2 ratio. Judging the company is connecting the dots. So you should have an understanding of P&L, balance sheet, and cash flow, and you have to connect all the dots, right? So it's not that 1 or 2 ratios can quickly tell you it is good or bad. Okay, let's go to the case study. Okay. I'll take the first case study of Ultratech Cement. Is it visible? I hope it is visible on your screen. So we'll study Praveerji. Say Ultratech is this company, and how should we look at? Because we are lucky people because we have this sheet with us. So creating this, if this is not there, then creating this output is a mammoth exercise. So let us look at first the sales of the company. Now, why we should start with the sales? Because sales is the heart of any company. It is the heart of any company. Now, if you look at from 20,000, it has gone to say 60,000 or 52,000, right, in 22. So in CAGR terms, 11% growth for 9 years, 5 years, 16%, and 3 years, it is 8% growth. Now, if you see that except 5 years, it is less than 15% CAGR growth. It's a kind of a company. It is linked with the GDP of the country. If the country will grow, infrastructure will grow, cement consumption will grow, right? But in the long run, if you see it has grown below 15%, that is something we have to understand that it is not growing in the long run of 15%, which is below our Technofunda standard. But in the 5 years, yes, but again in 3 years, it has faltered. Then operating profit, right? From 4,800 to say 11,000. And you see the growth. Long-term growth, 10 years, 17, 16. So 9-year growth is not impressive, but 5 year and 3 year is impressive. It is above 15%. That is the good sign. let us look at EBITDA from 5,000 crore to 12,000 crore. Again, say from 9 years CAGR growth is below 15, but from 5 and 3 years, it is in the medium term, it is really doing good. It is above our standard. So this is a good sign, correct? Then profit before tax, again the same story, 9, 17 and 35. And so is the profit after tax, against the same story. Then comes the ratio, right? The operating profit of the company. Now, operating profit of the company, if you really see 23, there is a cyclicality. If you really see 23, 19, 19, 19, 5, 25, 19, 17, 21, 25, 21, 17. So if you see, this is a cyclicality. And we know that cement has cyclicality because of its linkage with the GDP of the country. So what impression it gives? The operating margin is decent, because even the lowest, if you see, is around 17%, which is also a good margin, but it is cyclical. Why it is important to know? Because as margin goes up and down, profitability will go up and down. And so the price behavior, you will see in the chart that it goes up and down, right? Then net profit margin, double digit, is also very good, right? So the lowest is 5.8 and highest is 13.9 and average is 10.5, which is again a very good sign. But if you really see this year and this year, it is pathetically low as compared to the past performance. But they have bounced back, right, into the March 20, 21, 22. And again, it is showing, drastic change from 14% to 10%. And it requires to go deep and understand why this net profit margin is going down, correct? But this is a sign of worry. And that is why probably the cement stocks or the cement industry, this is the story. The stocks right now may not be doing that great. Then tax rate, if you really see, tax payout is 14%, currently 14% of their profits, and on an average 27%, which is okay. They can't do much because it is driven by the taxation regulation of the country. Dividend payout, okay. Company is repaying almost 14, 15% of their profit, average 12% of their profit as a dividend, right? Interest coverage ratio, as we discussed, see, fantastic. Fantastic, right? If they have to pay on an average, it is 7.2. So if they have to pay 1 rupee of interest, then they have a profit of 7 rupees available. So even if something goes wrong, they will not likely to default in their obligation to pay to the lenders. Earning per share is nothing but the net profit in per unit share basis. Okay, this is interesting. P ratio of the company. So 19 to right now 26, and average is 33, and minimum is 16, and maximum is 48. So these again, kind of a cyclical company where even the P ratio fluctuate, correct? Because profitability fluctuate. Now let us look at P&L from the different lenses, as we see in terms of the percentage terms, in profitability terms. So let us focus here in March 22. The company is earning 21.9% operating margin, which is anyways a very good. 20% is a good margin. But what is the major cost? Just see, material cost is around 16%, 23% power and fuel, and selling and administration 25%. So it tells me that major cost is selling and administrative expense. मतलब ये competition है बस, सेल डिस्ट्रीब्यूशन में, लॉजिस्टिक्स में बहुत पैसा जा रहा है, राइट? मटेरियल कॉस्ट इतना नहीं है, बट उससे ज्यादा पावर एंड फ्यूल कॉस्ट है. तो मार्जिन को मेंटेन करना है, तो सेल्स एंड एडमिन एक्सपेंस एंड द पावर एक्सपेंस, these two expense are very, very critical. So if when I study this company or con call of this company or the annual report of this company, I always look for what the commentary on the power and fuel cost, what is the commentary on the sales, logistics, admin expense, right? Distribution expense, because I know that can move the needle. Any efficiency in this line item can move the needle. So that I have to track. That is what this P&L statement tells me. Let's keep the quarterly because right now our idea is to understand the analysis, not the company as such in detail. Let us look at balance sheet, right? Now, whenever you look at the balance sheet, first, just see what is the size of the company. 83,000 crore size of the company. And just go down and see that out of this 60%, right? 60% is funded by the promoter and the shareholders. That means खुद का पैसा सबसे ज्यादा लगा हुआ. Borrowing is hardly 13% and outsider money is 26%, right? And these 60% actually going into the fixed assets of the company, right? Almost 72% is going into the fixed assets of the company for long-term use. Investment is 8%, that means some amount of surplus money they have, and their current assets are consuming 21%. Interesting part is what? My current assets only receivable is only 4%, and my inventory is only 7%. So it is not a high working capital driven organization, right? It is more fixed asset driven organization. And this 21% is entirely funded by the outsider, that is the shareholder, that is the creditors of the company, right? Suppliers of the company. तो मुझे वर्किंग कैपिटल में कुछ भी इन्वेस्ट करने की जरूरत नहीं है, पूरा का पूरा 21% मेरे सप्लायर, मेरे आउटसाइडर उसको फंड कर रहे हैं. And this is a good sign because anyway it's a good brand, it's Aditya Birla company. So working capital pressure ये कंपनी को नहीं है, neither on the receivable side nor on the inventory side. That is very, very clear. Now, having understood this, let us understand the net fixed assets turnover ratio. That, see, the 1.3, 1.1, 1.9, 0.7, 0.8, 0.9. That means almost 1. If I have a fixed assets of 1 rupee, my sale is almost 1. So what it tells me, if the company tells you that it is doing capex of say 100 crore, then you can say that more or less even ratio in the long term averages and short term averages are also near to 1. So अगर company 100 crore का capex कर रही है, तो you can take it for your back of envelope calculation that this will generate revenue of 100 crore. So when you want to understand the growth in the profit, growth in the sale, this is a very, very helpful ratio. How much growth can come? Because many times promoter तो कुछ भी narrative create करेगा, right? Owner of the company can create any narratives, but analyst will go and cross check that 100 crore capex can give maximum 100 crore of revenue. On that, say my operating margin is 20%. So 20% is 20 crore is my profit, and say my net profit margin is say 5%. Then say 5 crore is my additional profit can come from this capex. This is how you can connect the dots because this ratio is very helpful in this sense. Then receivable days, it is 20 days, it is with less than 30 days. Less than 1 month, I am recovering my money. That is a fantastic sign. If you see the long-term average is also less than 30 days, right? So these are a good businesses where you receive your money very fast. Then inventory turnover ratio, मेरी गोडाउन में जितनी भी इन्वेंट्री पड़ी है, मैं साल में कितनी बार घुमाता हूँ इसको, right? So the latest ratio is 10.9 and long-term average is also near 10, 10, 11, 10, 11. So which is good. That means साल में एक महीने में एक बार घुमा देता है. इसका मतलब क्या होता है? Approximately जो गोडाउन में जितना भी माल पड़ा है, within 1 month वो पूरा माल रोटेट हो जाता है, बिक जाता है. So velocity is very high, which is a good sign, because इनका working capital में पैसा जाम नहीं होता है. Debt equity very, very less, 0.2 only, and in the long run also average also always less than 1. तो ये कंपनी आराम से कोई भी एक्सटर्नल लिक्विडिटी इशू आएगा ही नहीं, उसका खुद का पैसा ज्यादा है, तो बैलेंस शीट में कोई बड़ा रिस्क नहीं है. कल टेम्पररी स्लो डाउन आ गया, कुछ भी आ गया, तो इसको ज्यादा लिक्विडिटी इशू या सॉल्वेंसी इशू आने वाला नहीं है. वेल फंडेड कंपनी है. Then return on average equity 15%, very good sign. 14.8, okay, close to 15. So this is also reasonably good. And long-term average also, if you see, okay, decent. Of course, this is less than 15, but not that down. So on the performance side also, this looks very good. Now the most important part is the cash flow. On the cash flow side, if you really look at, the first things we look at, of course, now all of you know that we will not get driven by the net delta. That's something which we will not. We will try to look at the story, right? So when you analyze the cash flow, you can look at that story which I have explained. But quickly, when we want to see, that what is the conversion of profit into the cash flow from operations, and see 174%, which is a dream. In 10 years, cumulatively 35,000 crore of profit, and the conversion in the cash flow is 61,000. 174 crore. It's a dream company, dream business model, right? And because एक रुपया कमाता हूं, लेकिन cash flow 1 रुपये से ज्यादा है मेरा. And you just see this. Entire 10 years, it is more than 100%. And it is actually increasing year after year, right? It is a fantastic sign. At least as per our Technofunda standard, this ratio has to be at least 80% if they want to qualify into your core portfolio. And these are dream businesses because there are entry barriers and there are very few players and there is a lot of consolidation. And that is why it is not an easy entry for anybody to come into the cement and create disruption into the market. Right? Then capex, right? What is the capex they have done so far? Right? 59,000 out of 61, they have reinvested 59. And what is the left with that? No, this is free cash flow. Okay. So almost everything they have reinvested, right? Close to 61 minus 59, everything they have reinvested. So they have a negative 2% is free cash flow because everything is getting reinvested, right? And if there is a growth opportunity, company will do that, and there is nothing wrong in that. So cash flow is also very good. Now let us look at the last point, and that is the viewpoint analysis. Now this is the 5-factor model. Let us look at. Let us first understand that this company is actually, okay, viewpoint is here. Okay, sorry. Okay, this company is earning 14.5% return, right? This year, 14.5% return, right, in the equity, say roughly 15%. Now, this is the very first 0.86 is about taxation. So 0.86 multiplied by 0.90 multiplied by 18 will give you 13.9. Will give you 13.9. So 0.86 is there actually the taxation burden. That means after paying taxes of 14%, what is left with them is 86%. Their interest, after interest, what is left is 90%. So interest burden on the profit is 10% only because it's a low debt company. Then margin, EBIT margin. This is most important. The EBIT margin is 18%. 18%. That means they are making EBIT profit of 18%. In the journey we have seen how EBIT is arrived at. So 18% they are earning in the EBIT. And their asset turnover ratio, that is investment bucket, right, is 0.6 only. And if you look at in the long run also, see 0.7, 0.6, right? So in entire balance sheet sides, right, it is always less than 1. Always less than 1. So this is not the key success factor. And their equity multiplier is 1.7. And if you multiply all this figure, you will arrive at 14.5. What the message behind this? That key success factor in this company is actually the EBIT margin. So EBIT margin is the function of, as we have seen in P&L account, is a function of not the raw material cost. It's more of a power cost and the logistic cost and SGU cost. So if you really want to understand this company, you want to read the commentary, you really have to see what is this company is doing in the power cost and what is this company is doing into the sales, distribution and logistic cost. That can actually improve the EBIT margin and that can actually improve the return on equity. Now, if you really see the year when this margin was very high, let's say is 17%. Now see, it was this 20%, right? And current year it has come down to 18%. So their equity return has come down to 14.5%. So key success factor in this business model or in this company is the EBIT margin. And EBIT margin is driven by in this company's power cost and the sales, distribution and logistic cost. So ये 3 चीज के ऊपर अगर आप एनालिसिस में हैंडल लेते हो, then you have a good grip on this company. I hope so far so good. Everybody clear? So Jamshedji just wanted to ask. It is almost 9 o'clock. Shall we continue? Take second case study, friends. Okay, thank you. So let us go to the second case study. This is an average company. This is an average company. And let us start again with the income statement. The name of the company is Shilpa Medicare, right? Now Shilpa Medicare Limited. This company say from 371 crore, now 22 is 1141 crore. What is the story? 9-year growth rate 13%, 5-year coming down, and 3 years again going back to 16%. That means 9 year not impressive, 5 year not impressive, but something has happened in the last 3 years where growth is above 15%. That means it calls for, बॉस लास्ट 3 साल का डेटा देखो, स्टोरी देखो, एनुअल रिपोर्ट देखो, कुछ तो ये कंपनी में हुआ है. It is giving a good growth. One need to find from this quantitative analysis, one has to move to the qualitative analysis and have to find out why it is bouncing back, very, 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 say impressively. Then comes the operating profit, say 13, 4, and 11. Now, this is okay, more or less, you can say 11, 13%, but in 5 years, it has drastically gone down. Now, that gives me an impression of volatility. That we are 11-13% growth, ठीक है, but 5 साल में 4% growth, why so much down? One needs to see in this year what went wrong, right? That is very important to understand this one. Then EBITDA income 18% up, 7% up, -14. This is very interesting. See, the sales is going up, your operating profit is going up, but your EBITDA is actually degrowing. EBITDA is actually degrowing in 3 years. So that means ये एरिया में और डीप क्वालिटेटिव एनालिसिस करने की जरूरत है. That sales growth होने के बावजूद भी EBITDA growth क्यों नहीं? Then interest okay, then PBT again see 9 year growth है PBT में, लेकिन ये 2 साल में नहीं है. मतलब क्या, इंटरेस्ट डेप्रिसिएशन सब कुछ खा रहा है, करेक्ट? मतलब शायद इसने बोरिंग ज्यादा किया रहेगा. जस्ट सी द बैलेंस शीट एंड सी द बोरिंग, right? 390 to 683 crore. Maybe that is why the interest cost is actually eating into the profit, and they are not able to show the growth into the profit growth. And same story in the PAT. So sales growth अच्छा है, लेकिन जैसे जैसे जर्नी में नीचे उतरते हैं, कंपनी का बोलते ना, लड़की का मेकअप निकल रहा है. Now you feel that original beauty and the beauty appearing to you is a different. So now the story changes. Then let us look at margin. Margins are 18, 20, 21, 20. Okay, but this is drastically come down into the PTA. Drastically come down. 17 to 11. Otherwise, it was always, in history never had this low margin. In the history never had so low margin. So again, it tells you go back to the qualitative analysis, find out what has gone wrong. Correct? Net profit margin. See, always double digit. Now 0.53 and now even less than 1. That means it's a sign of worry. Sign of worry. Something is going drastically bad in this company, and that needs to check. Then interest coverage ratio. See, drastically from 26 times to 3 times. Still, 3 times is also good, but the way it is going down is a matter of concern. It needs to go and really need to check, or either in the con call or in the annual reports, or one has to even talk to the investor relation department and try to understand that what is happening in this company. Then the P, that is interesting, that the P is actually re-rated to 57 times. I really don't know about TTM P kya hai, but it must have been derated by this time, I'm sure. Let us look at P&L in the percentage terms. 17% margin. Major cost, as you can see, is the material cost. तो अगर ये कंपनी के मटेरियल कॉस्ट को मैनेज करना, इंपोर्ट कंपोनेंट है कि नहीं, फॉरेन एक्सचेंज एक्सपोजर है कि नहीं, और इसका वेंडर के साथ में whether as we say is an upper hand or not, all these things needs to be checked, right, to go deep, because material cost is something which can make or break this company. Employee cost, one of the very, very high cost, and thereafter the sales and administration cost. So material cost, then employee cost, and the sales and distribution cost is a major cost. If company manage these 3 costs well, margin can bounce back. Otherwise, it can break the operating margin also. And when we look at the con call or annual reports or the commentary of the management, we should try to find out answer on these 3 line items. That is why these ratios or this particular sheet is important. Let us look at the balance sheet. What is the size of the balance sheet? 2876. On that, what is the turnover? 1141. अरे बाप रे, बहुत कम है. Just try to look at. करीबन 2800 करोड़ का बैलेंस शीट है और टर्नओवर 1200 करोड़ भी नहीं है. मतलब this is something is, this company demands more money but not able to grow that much of sales or convert that much of sales, right? But what is the good side of it, right? Let us look at the 63% is promoter and shareholders money. It's a good sign. 24% is borrowing and 13% is the outsiders' money. This is the creditors and provisions. This 63% he has invested, all 64, entire money is invested into the fixed assets. अपना पैसा शेयर होल्डर ने प्लांट मशीनरी में फैक्ट्री में लॉन्ग टर्म में डाल दिया है. इन्वेस्टमेंट 1% है, and this 24 plus 13, roughly 37% is actually going into funding the working capital, right? ये कंपनी अभी भी सॉल्वेंट है बिकॉज उसका खुद का पैसा लगा हुआ है. अदरवाइज ऑपरेशंस में नथिंग राइट नाउ इज एक्साइटिंग. नथिंग राइट नाउ इज एक्साइटिंग. Let us look at the cash flow, right? A very fast conversion 84%, very good sign in the long run, right? The long run 84% is a good sign. But if you see 17, 18 and 21, correct? It is less than 80%. That means this company has some amount of volatility. And when we look at this cash flow from operation, we really have to go deep and see what is the source of cash flow from operation. Right? Is it because profit is high, or is it because they are not paying the creditors, right? And that is funding to the cash flow from operations. If that is the case, then it is one needs to worry. अगर creditor को तड़पा पे payment दे रहा है, then optically you have a positive cash flow, but that is not the good sign. So that qualitative aspect we have to go and check, right? Then capex, right? Every year more or less the capex तो कर ही रहा है. एंड इसका देखो नेगेटिव कैश फ्लो है, फ्री कैश फ्लो है ही नहीं. पूरी हिस्ट्री में इसके पास फ्री कैश फ्लो है ही नहीं. दैट मीन्स ये ऐसा बिजनेस है जिसको ग्रो करना है तो कैपेक्स मांग रहा है, कैपेक्स करना ही पड़ रहा है. और इसके पास फॉर्चुनेटली 80% के ऊपर था, तो ये कंपनी सर्वाइव किया है. लेकिन अब जो मोस्ट इंपॉर्टेंट थिंग टू वरी इज ड्रास्टिक रिडक्शन इनटू द मार्जिन ऑफ द कंपनी. And that is where we want to go deep and find qualitative reasons and find out whether this is a structural change or whether this change are temporary in nature. If it's temporary in nature, then only turnaround can happen. Otherwise, if it is a structural disruptions, then the story is over. Then the story of this company is over. Let us look at DuPont analysis. See the pathetic return on equity. Return on equity is pathetic. 3.3% only, right? By any standard, right? Just see from this year onward, right? Always less than 15%. So nothing great, right? And here also you see equity multiplier. Okay, this is more or less 1.6. Asset turnover has been a very poor. उसको बहुत पैसा लगता है, उतना टर्नओवर होता नहीं है उतने पैसे से उसका. और इसका जो भी मेन फैक्टर है वो भी EBIT मार्जिन ही है. अगर EBIT मार्जिन इंप्रूव कर सकता है तो ही ये कंपनी आगे जाके अच्छा रिटर्न ऑन इक्विटी देगा. बाकी 3-3.5% कमाने वाला कंपनी में कोई बंदा पैसा लगाएगा नहीं, क्योंकि आपका सेविंग अकाउंट भी आपको 4% रिटर्न ऐसे ही दे देता है विदाउट रिस्क. सो and if something happens on EBIT margin which can improve drastically, I will say drastically, because if you want to come to 15%, say this is, even it comes to 22%, it cannot go to 15%. Even it comes to say 35%, it cannot go to 15%. Even it go to 15%, it can't go to 13%. तो 50% मार्जिन तो कहां से आएगा यूनिट का? तो अकॉर्डिंग टू मी दिस कंपनी, it's not something which excites me. In first 5 minutes when I looked at, I reject such company, because we have so many other options available, and try to invest your time there and find out gems. This company is not worth giving more than 10 minutes and to go deep into this company. So that is the second case study, that how as a fundamental I look at those things. And and that is from my side. If still you have any question, I can more than happy to answer. So P447 प्रवीण जी बता रहे, अब ये तो इतना हाइट नहीं पे तो how can one make money? Right? So that is the end from my side, end of the presentation and the case study. I hope I have added some value, and maybe the QIC participants might get some good idea about the this analysis, might help you. And all the best to all the participants for their semi-final round of the QIC. And if anybody has anything, if want to share something, want to analyze any company, we can always collaborate. Can also send a message on the JAL group and the part of the JAL group, right? Thank you very much. Anybody has anything, right, can always contact me. So Srimsat-ji, shall I now officially announce the closure and close the meeting? Right. Great. Okay. So thanks a lot, and see you again maybe in the QIC rounds, or hopefully maybe on a collaboration. Right. Thank you very much.